earnings, we're hearing from a lot of banks, but we're also getting some of the hottest names out there in a variety of industries. They're going to tell us what's happening in the economy, what the outlook looks like for the consumer, and what we could maybe expect for the rest of the year. So these are key earnings. There's a lot of them this week you could look at, but I picked out five that you're really going to have to pay attention to. And I know many of you own some of these stocks, but not all of them. But let's see, what are the stocks that are the key earnings charts you should be watching this week. So we're going to lead it off with Tesla, ticker TSLA. I know many of you own it because you tell me all about it on Twitter. You tell me you're never selling. And it's been a good hold if you've been in it multi-years, as you can see, and it's gotten its act together as far as earnings surprises or misses. Once it became profitable, the analysts actually had something to gauge for the earnings. So the company and the analysts kind of got on the same page there, and it only had that one miss in 2021 since the pandemic started, really, there in 2020. So that's a great earnings surprise track record, but the shares are off considerably off those 2021 highs. Over the last 2 years, they're down about 27%, but it has rebounded significantly here in 2023 off those lows, and it's up about 50% year to date. Now, the PE, nobody's ever cared about it before, but it's still not cheap with a PE of 48. But I know that everybody who owns this stock doesn't care whatsoever about the PE, but it's not a cheap stock here. And where will it go? What will they say? Is this a stock that's going to kind of tread water for the rest of the year, or can it gain some more momentum like it had at the start of the year? We will see. The second company is Taiwan Semi. This is also a big earnings report, and I know many people in the semiconductor sector love this stock and own it. This is the one that Berkshire Hathaway bought last year, but then sold the next quarter. We now know from Warren Buffett himself that he got out of it because he was concerned about geopolitical issues in Taiwan and didn't want to have to deal with that. But shares really sold off last year. We have had the rebound like we just saw with Tesla. Over the last 2 years, down 26%, but year to date now up 17%. That's outperforming the S&P 500. It's still a cheap stock with a PE of 15.6. They do have this good earnings surprise track record with 9 meets or beats in a row. That's impressive, especially given everything that's been going on in the semiconductors. But the street, a little leery here. It has seen, the big move off those lows. Is this all the Taiwan Semi is going to get for the next couple of months? We don't know, but we're going to tune in to find out. Then I'm switching over to the railroads. This is a key part of the US economy. It had the big rally off of the pandemic lows there in 2020. It has a pretty good earnings surprise track record. It has some misses thrown in there, but it's not too terrible. And there's small misses. But this is the type of company that has just like the small beat or the small miss and not a lot of surprises. The shares are considerably off those 2022 highs, however. And so maybe this is a buying opportunity in some of the rails, or maybe not. We're about to find out. Over the last 2 years, these shares are down, but only 11%. And year to date, they're down. So they're a little weak here, down 4.1% on worries about a slowing US economy, because that means less, volumes on the rails if the US economy is slowing. So this is going to be an interesting one to watch. It is one of my favorite rails, and the PE now back down to 17 times. That's still not super cheap on a historic basis. So we'll see if the shares can get any momentum or if they're going to continue to kind of sell off and retest those 2022 lows. We will see. Then I'm switching it up and going back to the home builders. They've stayed a big recovery off of those lows. And the one reporting this week is D.R. Horton, one of the bigger national home builders, ticker DHI. And these have been surprising for most of this year, actually, because everybody expected them to basically slide into oblivion on these higher mortgage rates. But that's not what's happened. Yes, they are selling lesser homes, they are getting fewer orders coming in, but they're able to keep a lot of the record high margins that they were able to get last year and in 2021. And that is the important metric for the home builders. So, will that continue? Will we continue to see them with those higher margin? I don't know. But right now, they are able to kind of maintain some of their pricing power. Price of lumber has come down, but other things are still elevated, and they're still having some supply chain issues, which they think will totally work themselves out by the end of the year. But that's a couple months away, right? And we have rising commodity prices on some things like copper. So, where will this all play out? We don't know, but the prior earnings reports have been pretty decent, including the guidance that they've been able to give. So, are they still seeing fairly strong, foot traffic back into those sales centers? This is a key one to watch. And as you can see, they also have an outstanding earnings surprise track record. Just one miss since the pandemic started. That's impressive because they were in a vulnerable area of the economy when the pandemic hit. Not that everything wasn't vulnerable, but home building kind of halted there at the start of the pandemic until they figured out online shopping for homes and various other things. Then it took off. Over the last 2 years, these shares are still up year to date, or up 2% in over those 2 years. So they are still a little bit green. Year to date, they are up 10%, booking the trends that they should be down. The shares are still cheap on the home builders, trading at 10 times, but those earnings have really come down. So they have a little bit of a value trappiness there. But is the worst over for the home builders? We will see. Then I'm going to wrap it up with one of my favorites, but most people don't know this company, even though it was one of the best stock performers of the last 30 years. Pool Corp, yes, they make pools, and they're one of the dominant players in that industry, both here and in Australia, and basically anywhere where they're building pools. I'm not sure they're in Europe, however, but big, huge pool company. They also do all the outdoor goods. So when the pandemic hit, everybody rushed out to buy outdoor furniture, grills, all that stuff. They do sell all of that. Everybody rushed out to add a pool. If they're going to stay at home for the next however long a period of time, they wanted that pool. But those sales have come way down, as you might expect. We're seeing a return to pre-pandemic levels with a lot of these, furniture retailers and now outdoor goods. And so that has really showed up in this chart. You can see it's well off those 2021 highs, and it looks to have bottomed last year in 2022. But I've been watching it because we have seen a steady slide here in 2023 on worries about the consumer, and whether or not they're going to keep spending on something like this as the economy slows. They did miss last quarter. It was a rare miss. It was a first miss since 2019. And so things are getting a little bit more difficult to gauge for the analysts on a company like this. Year to date, these shares are still up 9.2%, but you can see, as I just mentioned, they're going in the wrong direction. Over the last 2 years, they're down 13.6%. But as I mentioned, it's one of the best performing stocks of the last 30 years. So that's a small, pullback, relatively speaking, if you are a longer term shareholder. Pool Core, has been rewarding shareholders. It does pay a dividend, and it might even be doing share buybacks. I'm not sure, but this is one I'm going to be tuning in on and watching this quarter because the consumer is where it's at, and this is a key area that they will pull back on if they are getting a little bit nervous here. So as you can see, this is a busy week. There's a lot of industries reporting. Don't get focused on just, the Teslas of the world. There are a lot of other companies that are going to be giving us really good indications of what's going on out there. So I'll be tweeting out a lot of these charts And there's many more that I just can't fit in onto these videos. So be sure to follow me on Twitter at Tracy Reinick. A lot of these charts will also be on my Stock Twits account. It's also the same name, just at my name at Tracy Reinick. And you can also get all of the earnings data that Zacks is putting out, and we put out a ton of it every week during earnings season. Go to Zacks.com. There's an earnings tab up at the top of the page. Click on that, and you'll see there. You can find the earnings calendar. You can see where the surprise are every day. You can see Shiraz Mian's great earnings articles. But be sure to get all of our information because we are the earnings headquarters during earnings season. So be sure to tune in, and I'll see you again next time with some more earnings charts.